Hi, everybody. So, in this video, we're going to talk about the great innovations that drove economic development uh, in the 20th century, basically. And those two things are the corporate form, corporations, and the evolution of the stock market into something, organized. So let's go for it here. And we're going to talk about two great innovations. You kind of don't think of them as technical innovations, but they are, and they've been amazing at what they've been able to achieve over, in as far as economic development over the last hundred some odd years. Um, so this is how modern capital markets have been born and formed. So basically, it's a stock market, right? And so there's two things: what is a stock, and what is a market? So that's what we're going to talk about here. And so a stock is based on a corporation, right? Corporations issue stocks. That's the ownership of a corporation is divided into many little pieces of the pie. It might be 1 million shares of stock. It might be 500 million shares of stock, and in the company's 10Ks, financial statements, it'll say on the balance sheet how many shares of stock are authorized to be issued and how many are actually issued. Right. So a corporation is an entity that separates ownership from control. And the way it is, ownership is the shareholders, the people that own the company. And when you buy a share of stock, you're becoming a shareholder or a stockholder. Those are interchangeable terms. And then and what the shareholders do each year is they elect the board of directors. Now it's interleaved, like and it's going to be an odd number because you don't want to have a vote where there could be four on one side, four on the other, and it's split. So it's usually 7, 9, 11 people, something like that, a manageable amount, but an odd number. And the board is elected by the shareholders through the proxy statement each year, at the annual meeting, and and usually maybe each board member might serve 3 years or something, and then you interleave them so that you don't all the board members don't go at one time, so you have that institutional memory going on. So the shareholders elect the board, and so they're the shareholders' representatives, and then the board of directors goes and hires the management, the CEO, the chief executive officer, and the other people in the C-suite. The CEO will with board approval, will hire like the CFO, chief financial officer, and the CTO now, the chief technology officer, and the CIO, chief information officer. There's a whole C-suite now. CMO, chief marketing officer. Um, and then those people go and hire the people under them to manage the organizational. So that's how a corporation is structured. And then there's authorized shares. You can only issue a certain amount of shares authorized under your articles of incorporation, and you can't go over that. And then there's the outstanding shares. They don't all get issued at once. You might be authorized 50 million shares of stock, and you might have issued over time 27 million shares or something, and you still have that headroom, that additional shares that you can issue to raise more capital in an offering, a public offering. And an IPO is the initial public offering. That's when a company goes from being a private company to being a public company. Publicly company meaning being traded on the stock market, so that there's all this trading back and forth. Um, I have quite a bit of experience in that. I took two companies public and ran them for 15 years. So it's quite a thing to do. um, so let's talk about more about a corporation. And a corporation is a legal entity separate from its owners. It can own property, enter into contracts, sue and be sued independently of any individual. So there's liability protection there for the owners. The owners aren't liable for everything that the corporation does. The shareholders can only lose what they invest in a company. Personal assets are separate from that, protected. And it allows for perpetual existence. In the olden days, companies, if the founder or the leader retired or died, that was the end of the company. What this allows for is a organizational structure Let's look at these companies like General Electric or General Motors. They've been around for 100 years. They've had, maybe a dozen or more CEOs and operators that have run it, management that has run it, and it's run smoothly over time. So they can exist in perpetuity. They're not, limited by the life of any one person. So here's basically the structure as we talked about. Shareholders, they own the corporation via the shares. They're the ultimate principal. So when you buy a share of stock, when you go to your Schwab account or your E-Trade account or something and buy a share of Tesla or Apple or whatever, then they are working for you. Those people are working for you. You are the owner. And that's just a miracle, I think. It's just really, really so cool. And the board of directors is elected by the shareholders, and they set the strategy, they hire the CEO, and they oversee management. That's the board of directors. They're setting the direction of the company. And the CEO and the rest report to them and tell them what their plans are, and then the board of directors ratify or approve those plans. And then the CEO and the management, CEO again, chief executive officer, and they run the day-to-day operations, report to the board, and they're accountable for results. If they don't perform, whoosh, they get fired by the board of directors, and we get somebody else new in there, right? So it's a separation of ownership and management, and that's what allows corporations to scale without limit. It's really quite incredible. So the separation of ownership and management, that's my dog in the back. So owners are the shareholders, and they provide the capital, right? They bear the financial risk. They receive the profits, dividends, basically, and they vote on the major decisions, and they do not manage the operations. The managers are the CEO and the board, and they run the day-to-day operations, hire people they're hired for their experience and skill. On the board, you might have 7, 9 people, and they're all different. One might have experience as a manager, or was a former CEO, and then one might be a corporate lawyer, one might be a marketing person. One might be a human resources type person, and one might be a technical person. And all these people then have these different expertises that get put together. And the managers are accountable to the board, and they may own shares. They usually do. You want them to actually own shares so that their incentives are aligned with the shareholders. That's really a key feature. And they act as agents for the owners. So, yeah. So shares, now talking about authorized and outstanding. That's sort of a nuance that we have to understand, right? Authorized is the total shares that the company is allowed to issue per its articles of incorporation, its corporate charter. And issued are the shares that have been sold at any point during the corporate's history. Outstanding are the shares currently held by investors, and treasury shares are the shares that the company has bought back from the market. They're already been issued, bought back, and they hold them in treasury. And buybacks have become a big thing in the last couple of decades here. When we're trying to maximize shareholder value, has been the thing. If the company can see maybe that they feel the shares are underpriced, they buy them back in the market, and then obviously there's if the company keeps the same valuation and there's less shares, then the per share price is going to go up, right? Because that's how you value the company. So that's why that's been a great thing for shareholders. Basically, is if the company does a buyback, then their shares are worth more because there's fewer shares dividing up the value of the company. So let's talk about the going public process. In the initial public offering, a company is a private company. Say it's been founded. There's a founder, and then there's been some angel investors, and then a couple of rounds of venture capital put in, and then the company gets to a mature place where now it's going to go public. So the traditional way is you hire an underwriter, like a big bank, Morgan Stanley, or JP Morgan, or or Goldman Sachs, these investment banks. You hire an investment bank, and they price the IPO, what each share is going to go for and all. And then they actually distribute. They have a sales team that, sells it. file a prospectus with the SEC, the Securities and Exchange Commission, which regulates public companies, and that has all this information in it, the prospectus, and the potential investors read that, and the SEC reads that, and make sure that the company is transparent in what it's doing and saying, truthfully what it's going to do. And then they go on a roadshow and pitch to institutional investors that are going to place those initial shares. And then the IPO happens, and it might be listed on the New York Stock Exchange or NASDAQ. And that's when the public can get in on this company. We're talking now like, SpaceX might go public soon and all these other ones. And those are exciting events and can be very lucrative for people to be able to invest in them. So the primary market is, say, if a company issues stock uh, to investors, the company receives that money. That's when when shares are sold for the first time. The company raises capital directly. There's two ways that a company can raise capital, right? They can issue shares, issue equity, they call that, or they can issue debt, and then they're keeping the equity concentrated, but then they're taking on debt, and they have debt, loan obligations. So it's a balancing act. So IPO and follow-on offerings are a primary market deal where the company gets the cash. After that, it's the stock market is a secondary market. That's where between investors, like one investor sells to another, that the company doesn't get any cash. The one who sells, the investor sells, gets the cash, and the one who buys the shares, pays for it. So it's existing shares traded between investors. The company doesn't get anything there. So that's a fine point that you have to, that it's good to understand. So now we're going to turn to what is a market. We talked about what's a stock. We're talking about stock market and those two terms. We want to really unbundle them so we understand what it is, right? So we'll talk about these things, crowdfunding for companies. Again, people allocate their capital to the best deals, and in mass. There's millions of investors in the stock market, and the market's supply and demand, and where the price is where the market clears. It's an auction. Stock market is an auction. It's a bid and ask prices, and it's an auction that goes on all day long while the market is open. And it's price, basically, there's an interesting phenomenon called wisdom of crowds that we'll talk about a bit. And it's basically looking at the discounted cash flow, right? The present value of the future cash flows is the value of the company. And everybody's making that estimate, whether you do it sort of intuitively or like an analyst do it very quantitatively. And the market provides liquidity, right? You can buy stocks in a company, and then you can sell them, and sell them that day, and it'll clear, and the money will be available in your account in a day or two. Whereas illiquid markets, like say selling your house or something, takes a long time and is chunky. So you can think of the stock market as sort of crowdfunding for companies. If you're a single investor, there's only so much you can do, right? You can't fund a big factory or a skyscraper or something like that. Partnerships, you have more money, that you can get, sharing the risk and all. But the stock market is where millions of investors pool their capital, and the risk is dispersed, and companies can finance they can raise all kinds of money. So the market is supply and demand, right? The demand, if there's a demand for something, that drives up the price. There's more buyers than sellers. The price rises. If there's supply, if there's more of something than people want to buy it, then the price goes down. That's what happens with stocks too. If there's people really want this stock, the price is going to go up. If there's people are selling it and there's a bunch of supply and people aren't buying it, then the price goes down. And where the buyers and sellers agree on a price, that's called the market price. That's where the market clears. So that's a key thing to think about with the stock market, right? The stock market is an auction, and it's going on all the time. Say the bid might be, somebody saying, I'll, buy a share for $149.85. That's what a buyer's willing to pay. And somebody saying, I will sell my share for, 49.90. And, so there's usually in a very voluminous market, that spread between those numbers is very small, and it's very accurate. So The spread here is 5 cents. And so when, say, if they cleared at $49, 149 and 87 cents or something, they both come together, and that would be an execution of a trade, and that would be the new price at that time. And that's why you see all the, in a day, you can see, if you look at the stock price, it's going like this, because each one of those trades, puts a dot down at this price, and then the next trade is done a little higher, the next trade a little lower, and you see this squiggly line. Those are every single trade that's being done, and how the price is moving. So that's how you can tell the price. So that squiggly line, that's what that is. It's just the price going up and down as each trade is consummated. So let's go to the next slide here, and supply and oops, I was a little bit behind there. Yeah, the stock market is an auction. We just talked about that. And now, how do markets find their price? The way that markets find their price is there's millions of buyers and sellers, submit their bids and asks, and each participant, brings their own research and information to it, and these trades are executed continuously. The latest trade reflects the collective judgment of everybody, and as new information comes in, that information is immediately, this is the efficient markets, hypothesis. That information is then priced into, whatever's happening, new earnings news, macro data. If there's something in the economy that happens, the price will adjust to, reflect that new information. And the market price is the best available real-time estimate of a stock's price. That's what it's all about. And, the price is the best guess of a stock's true value at the moment. And that's the efficient markets hypothesis. And what we'll look at too, I'm going to, show you a video about the wisdom of crowds, which is basically that it's amazing that so many people guessing, actually the average of those guessings, which is the price, is a very accurate reflection of the true value of something. So let's go here. So, yes, the wisdom of crowds, and that's what I'm talking about there. Um, so this is really fascinating. This is basically what I was talking about. Francis Galton, who invented statistics, basically, he went to a county fair in 1907. He was in his 80s, and he was still incredibly just curious and stuff. It's just amazing. And he went. There was 800 county fair attendees who guessed the weight of an ox, and the crowd's average. Nobody guessed it right, but he took all those little pieces of paper that people guessed on and averaged them together. Basically added them up and divided by the number of the guesses, and the average, came out to within 1 pound of the cow's true weight. I mean, just it was remarkable, And then there's a great book by James Sorowicki, The Wisdom of Crowds, where he goes into that and into other aspects of that phenomenon, and crowds reliably outperform experts when judgments are independent, diverse, and decentralized. And the stock market satisfies those three conditions. So that's why they call the stock market a price discovery mechanism, because it's this wisdom of crowds phenomenon that's actually coming up with a very accurate price by everybody guessing around, the present value of those future cash flows are. It's really remarkable. And I'll play the Planet Money, the NPR piece on that. It's really very fascinating. And I want you to hear that. So, the stock price is discounted cash flow guesses, right? We don't know how much Google is going to make, in net income or free cash flow in years, 2, 3, 4 years out. It's a guess, and what discount rate to discount it back to the present value is. But those are the kind of guesses that everybody's making. And analysts project these future earnings, and free cash flow, and they do it very quantitatively. But still, they're, anybody who is, banking on a crystal ball is going to end up eating glass, kind of thing. They don't really know, but they discount them back. And different analysts, different assumptions, different prices. That's the wisdom of crowds, then, right? And the market price is the current consensus of all those estimates. So no one knows the future, right? The stock price is not a fact. It's a price discovery mechanism in the market, right? It is the market's best collective guess about what future cash flows are worth today. And that's the brilliance of the market. I mean, that it actually discovers a valuation, a price that then we all agree on. And if we don't agree on, then we either move it up or down, right? And that's how it goes. Absolutely remarkable. The other thing that the market gives is liquidity. You can, buy shares and then sell shares all the time. That's the confidence that whenever you want to get out of a stock, you have the confidence that there's going to be somebody on the other side of that trade that will be willing to buy it because you have these narrow bid and ask spreads, low transaction costs, and they trade in seconds at what we deem as a fair price. It's an agreed on price, transparent price. It's easy to enter and exit positions. That's the beauty of liquidity in liquid markets. Think of an illiquid market like trying to sell your house, right? You got to put it on the market. You got to go get a real estate broker. You got to pay them. So there's transaction fees. It may take months for the deal to close, right? As the other person gets their financing. All these things happen. The price, there's an appraisal done where they look at comparables of what happened, what sales were in the last few months in a comparable kind of property and adjust your property to match what those other properties were. But it's an illiquid market. It's not as there's a lot of frictions there. It's not like just I want to sell 100 shares of my Google position and 2 seconds later sold, and the next day it's cleared through your account and you can use the money. That's the beauty of of liquidity. Um, so this, what did they make? What these two innovations, technical innovations made possible was, large scale enterprise, the corporation, by separating ownership and management and limiting investor liability, absolutely key. And the stock market created price discovery, liquidity, and a mechanism for millions to efficiently allocate capital to the best projects. And those two things together have been what has really been they have been the engine of uh, of economic development. So together they give ordinary people a stake in the growth of an entire economy. Really, really a wonderful and magical thing. So um, I hope you enjoyed that, and I'll catch you next time. Take care. Bye.